Good morning and welcome back, everyone, to our Monday morning Trade Ideas webinar session. My name is Tony Zhang. I'm the Chief Strategist here at OptionsPlay. And this is the session where we go over the weekly macro outlook across the entire asset class, and then where we introduce the trade ideas for the week. So let's go ahead and get started. Now, before we do, what we are going to do here this Thursday for our options education session will be a deep dive into DeepSeek AI, specifically how DeepSeek R1 stacks up against the leading LLM models that we have here in the US up until now, how they stack up. We'll be putting it through its paces compared to the tests that we have put the leading LLM models against and see how DeepSeek stacks up. And then more importantly, I think what we're going to do is take a deeper dive into how does DeepSeek change the landscape of investments within AI. We'll be covering all of that this Thursday at 4:15 p.m. So please register for that event by scanning the QR code here on your screen. Really important session if you have investments within AI or thinking about investments within AI, to think about that landscape and potentially what changes DeepSeek has had on that overall industry. All right, so let's go ahead and get started with the S&P 500. Now, last week, we made another crack at the all-time highs. And interestingly enough, as we made a crack at these all-time highs, we failed again at those all-time highs to break out higher and continue moving. This is the second, or even you could call it even the third attempt at a new all-time high that largely has failed. We're just testing the 50-day moving average here on all of the major indices, on the S&P 500, on the NASDAQ 100, and also on the equal weight S&P 500 index. All three are basically pulling back to the 50-day moving average and testing it as support, with the exception of small caps, which recently failed at the 50-day moving average and started to roll over here. So largely, if you look at equities from this perspective, it's not particularly on a strong foot. We spoke about this here a couple of weeks ago, and last week we were off because of the holidays, but largely what you have here is an equity markets that's failing to break out at all-time highs. Just not a particularly strong sign. The one thing I will say is that investors right now are overly bearish. Even though we are effectively within spitting distance of all-time highs. You have the VIX at 18%. You have the AAII survey coming in at about 47% of respondents saying that they're bearish. And typically these things can be seen as a bit of a contrarian indicator. When so many traders are bearish, that could be the catalyst of the next move higher here. So we'll keep a close eye on it this week to see if equity markets can resolve itself and break out to all-time highs and continue. But so far, price action at these all-time highs and how we're responding to these all-time highs has not been particularly strong here, and instill a lot of confidence that we're ready to break out higher and just continue moving on. Growth versus value, one has not really outperformed the other in nearly a month now. Commodities so far has moderated a little bit, with gold continuing to grind higher, but oil kind of pulling back to that $70 support level. HYG high yield corporate bonds continue to grind higher. This provides a bit of a risk on backdrop here for US equities, but as you can see, it is continuing to just slowly grind higher here. The VIX, as I said before here, a very elevated level, 18.2% on Friday's close. So, we obviously pulled back substantially here on Friday, but, considering how close we are away from the all-time highs, that's a particularly strong, a high reading here for the VIX going into all-time highs. Now, we have found a bit of a backdrop that's slightly more supportive of equities. You have the 10-year yields back down to around below 4.5%. We're back to 4.4% here. Bonds are catching a bit of a bid here. We're seeing that 50-day moving average starting to provide a little bit of support here. And we could start seeing that 50-day moving average flatten out and potentially even start curling higher if bonds can continue to rally from where we are right now. That certainly will provide a more supportive environment for equities if we do see that happen. The dollar index is now broken below that major support level around 107 or so, and that's going to provide some level of support here for equities as yields continue to decline. The dollar weakening here is definitely more of a concern here for US consumers because a weaker dollar, especially in the face of all the tariffs that have been either put in place already or threatened to be put in place, a weaker dollar is going to be more impactful with these tariffs versus a stronger dollar to some degree offsets some of these tariffs. A weaker dollar um, increases the impact that it has on US consumers. But in the meantime, gold continues to grind higher here. We've still on our way to 3,000, or with an upside target of 3,100 for us on gold. This has just been one of those slow grind higher that we've seen here and over previous breakouts here when it broke out above 2,800. I'm sorry, when it broke out above 2,400, it took a while to grind higher here and then traded sideways. And now we're breaking out higher here again on our way towards 3,100 for gold. And oil recently pulled back a little bit to that 71 level here. And that's an important level to pay attention to here on oil, because if we break below that, that certainly starts to put oil further into pressure down into the lows, into the high 60s, which was the all-time lows that we saw here last year. That would be our final support level here on oil. And given that just the oil fundamentals here, that very much seems more likely that we will break below that $70 support and eventually test that $68 support here to the downside. So then looking at sector rotation, we have seen a fair amount of rotation into more defensive sectors like consumer staples, utilities, but at the same time also rotation into technology. Um, so we've seen technology after what has been a pretty significantly long period of effectively no performance, underperform a little bit recently, and then outperform a little bit here in the last couple of weeks. So largely not a whole lot of movement from technology. But if you look at consumer staples, consumer staples have lost a significant amount of ground here in the last, call it 6 months or so. But in the last month, really started to play a little bit of catch up here, playing a bit of a defensive role. We've seen stocks like Pepsi and Coca-Cola perform incredibly well here over the last month or so. And that's contributing to some of the gains we're seeing out of consumer staples. We've also actually have seen utilities strengthen quite a bit here over the uh, last 2 months or so after what has been a period of underperformance for utilities. And then on the flip side, we have seen consumer discretionary, which has been a strong performer of late, really start to show some weakness here. Consumer discretionary, one of the strongest sectors here over the last 6 months or so, has given up some of those gains here in the past few weeks. And notice if you look at consumer discretionary from a absolute perspective, we broke out above that level from support. We've now tested it twice as, as resistance. We've now tested it twice as support. We've broken below the 50-day moving average. The 50-day moving average, 50-day moving average has flattened out here, and this is now at risk of potentially breaking down and significantly underperforming going forward. So consumer discretionary, a primary driver of the US economy, at a pretty pivotal juncture here right now with price action with relative strength. So really important to keep an eye out on if we see further weakness here from consumers. We have some major reports of this week with Home Depot giving us another reading on kind of the strength of the U.S. economy. We've seen multiple retailers disappoint. We had Walmart disappoint. We had Target disappoint. So this is definitely something that we need to keep a close eye on because one of the primary drivers of the U.S. economy is U.S. spending, or consumer spending. And there's definitely fundamental and underlying data that's coming out that's suggesting that consumer spending is slowing down. You have the airlines taking a hit in a pretty massive way on Friday. You've had credit card debt continue to accelerate and grow to the upside, and in a high interest rate environment, that's going to certainly dampen the consumer's ability to continue to spend at the pace that they have. And these are going to have ramifications across the entire US economy. So we're going to keep a very close eye here on consumer discretionary and how that lands, because that's going to be a primary leading indicator of the strength of the US consumer. Industrials have lost quite a bit of ground here as well over the past couple of months. Home builders really starting to fall apart here a little bit here. We took a bearish view here on home builders towards the end of last year after the election. And even though it did have a chance to recover back to that 50-day moving average, it sold off pretty heavily, revisited that support, and actually started to break down here even further. So home builders at the moment looking incredibly weak, underperforming the S&P 500 by a very wide margin here over the last 6 months or so. And then semis, also, as you can see, over the past nearly a year now, we've continued to see underperformance of semiconductors relative to the S&P 500, even though it is one of the leading industries globally. The underperformance for semis is definitely concerning. Now, NVIDIA does report here this Wednesday, so we'll keep a close eye on that. But NVIDIA really stands out as one winner versus most other semiconductor stocks at the moment are still underperforming the S&P 500 at the moment. So that's where we stand with regards to the macro view. Now, I think let's turn our attention here to looking at the ideas here for the week. Now, for those of you that are new, if you're joining us for the first time, we maintain a list of all the best bullish stocks and bearish stocks in the market here right now on these Monday morning trade ideas sessions. Now, if you have a OptionsPlay account, either a free trial or a subscription to OptionsPlay, you will get this report in an email every single Monday and every single Thursday. This is our trade ideas list that we pull from for our daily trading signals that we send out for options trading. So for example, I sent out a trade of the week here for options on Apple this week. So if you want to have access to those daily trading signals for options, please sign up for a free trial or your subscription here at OptionsPlay to get access to our daily trading signals for options trading. But those options trades that we pull out for Monday through Friday are from this report, right? So the idea of these Monday morning sessions is to make sure that we do a full review of every stock that we have a bullish or bearish view on, walk you through every single technical chart and fundamental thesis so that you understand why we are taking a bullish or bearish view on the stocks that are in this list, because we will take potentially any of these stocks and send you a trading signal Monday through Friday morning with a trading signal on the options for one of these stocks. And the goal here is just to make sure that you have your homework done by Monday morning with why we have a bullish or bearish view on these stocks, so that if we send you a trade idea like the one I'm sending you this morning on Apple, you've already done your research with the chart, you've done your research from the fundamentals, and you're ready to pull the trigger on a trade signal like the one that I'm sending out this morning on Apple. So I'm going to be doing a trade of the week every single Monday that goes alongside with this report. And it's essentially, the best options trade on the stocks that you have on your screen so that you can quickly identify potential opportunities to outperform. Newmont Mining, the stock is effectively flat, but we eked out, a 66% gain on an options trade just last week. That's just one of many examples where we were able to turn a 5-10% move in the underlying stock into a 50 to 100% return on the options trade. And that's really kind of what we provide on our daily trading signals is the opportunity to turn a 5% return into a 50% return using options. So we just sent out a trade idea this morning on Apple. For those of you that are currently subscribed to OptionsPlay, you would have received that trading signal in your inbox this morning. Okay, so let's go through the trade ideas list. And as of today, we're closing one or removing one trade from our list, which is XYZ Block. Block recently reported earnings that were below expectations on both top and bottom line. So this is one that, based on that new information, we have decided to remove from our bullish list here at the moment for XYZ, which is Block. So let's take a look at the stocks in our list here right now. The first one here is Alibaba. Now, Alibaba falls into a category called bullish outperform, meaning these are stocks that are outperforming the S&P 500. And not only are we looking for stocks that are outperforming the S&P 500, we typically look for stocks that are sort of bottoming. So I'll show you some of the charts here that we have, but most of them kind of exhibit this kind of format where over time it has underperformed the market and then has kind of consolidated itself for a period of time. So as you can see, it's consolidated itself for the better part of 2 years. Now, this is a weekly chart. It has really consolidated itself for the better part of nearly 2 years in this trading range. And just recently, as you can see here, it started to break out here to the upside. And what we want to see is this breakout after a bottoming formation with outperformance of the S&P 500. And that's what we got out of Alibaba. So this is a weekly chart, and our upside target here is well into the 200s. Alibaba currently trading at 140, 145 or so. So we have a pretty significant upside target here for Alibaba. This happens to be also one that's worked out very quickly here. As you can see, we just added it last week on February 18th, on last Monday when it was trading around 125. The stock's gained 15% already since we've added it. And if you look at the fundamentals here, we're trading at about 14 and a half times forward earnings. If you look at kind of growth expectations, it is very much in line or slightly exceeding growth expectations for the industry, net margins that are also exceeding its industry, yet it trades at a pretty substantial discount, as you can see, to its industry average. There's many reasons why it trades at a discount. The fact that it's a Chinese stock with different accounting standards that typically does carry a discount in terms of valuation if all other things are the same. It also has carried a lower valuation because of the regulatory environment that China has instilled on its tech and financial services companies that Alibaba kind of straddles both within. But it's very clear that recently, and part of the reason why we added it on our bullish list is because China, which has struggled substantially with the restart of its economy after COVID, has tried multiple policies from monetary and fiscal policy to jumpstart its economy, of which most of those initiatives or campaigns have either failed or have had little impact. So China has clearly recently turned towards its major tech companies to be a potential driver of growth. You could say that they're trying to follow the US template of letting the tech companies lead those countries in terms of growth, and they've certainly have reversed their tone with regards to from a regulatory environment. We've seen Jack Ma be back in the spotlight after having largely been out of the spotlight for the last 2 to 3 years. Um, Instilling a new level of confidence in some of these tech companies. So that's why Alibaba, after what has been multiple years of underperformance and trading at very bottom valuations, have now become at the forefront of our trade ideas. And as you can see, just based on momentum, we've seen an incredible amount of momentum from these Chinese tech stocks in just the last week or so. So we expect that there's going to be likely some um, continuation of that momentum going forward in the short run as China really turns to these companies to provide kind of the next level of growth that they're looking for to hit their economic targets. With that is PDD, the retailer for Temu. Now, this one I will admit carries on more risk than the other two Chinese tech companies, which is Alibaba and Baidu, simply because of their of PDD's is effectively right in the crosshairs of some of the tariff fights that President Trump is trying to put up with China. It is subject to the de minimis rule, meaning the entire business of Temu is operated with the de minimis rule here in the US. It's important to understand that rule if you are investing in this particular stock, because if you look at companies like Temu, they rely entirely of their business model on the fact that it doesn't require a product to go through US customs if the product is value is less than $800. That rule is subject to change. That rule is certainly on the chopping block. So there is some substantial risk to the overall business model to firms like PDD. But until um, that I wouldn't call it a loophole because it's legal, until if that uh, de minimis amount were to either be significantly lowered or to go away, that would present, in my opinion, a pretty existential risk to stocks like PDD. So just be aware of that risk as an investor. Given the fact that we are mid a trade war fight with China on this front, but overall, you have a stock that very similar to the other stocks have underperformed by quite a bit. And then over, let's say a 2 month time, 3 month time has really kind of formed a bit of a bottom and now started to break out here to the upside while outperforming the S&P 500. So from a chart setup perspective, very similar to Alibaba, more so on a daily time frame. Now, the thing is that despite the risks that I just referred to, look at the valuations it's trading at. Industry average of 22 versus PD is trading at 10 times forward earnings. But if you look at the growth expectations, we're talking about head and shoulders growth faster than the industry, right? So 31 to 32% top and bottom line growth. There's almost no US retailer or retailing or consumer discretionary stock that's touching a candle to what PDD is experiencing in terms of top and bottom line growth. Also, if you look at net margins, there is almost no US retailer with net margins that are close to 30%. Some of the better performing stocks that we like in the consumer discretionary space, like Lululemon, are in the 15 to 70%, 17% range in terms of net margins. And PDD is nearly double that, yet it trades at a discount that's more than 50% to the market. That's part of why I'm still willing to take on the risks here, despite, the trade war risks here for PDD. So, because of just how significantly discounted it is from a valuation perspective. So as China kind of starts to unleash some of these companies from a regulatory perspective, I expect that's going to unlock a fair amount of shareholder value and present significant upside. If we look at Newmont Mining, this is effectively a gold trade, a leveraged gold trade. We've seen Newmont Mining pull back here with regards to the chart pulling back and then breaking out from that pullback here. That's what we were basically trading, is that pullout, is that breakout here from Newmont Mining above that $45 level here to the upside. Note as trades at a discount relative to the industry, despite its growing. A little bit slower than the industry, but look at net margins here, more profitable than the industry. It's recovered those net margins nicely over the last quarter or so, and it creates a substantial upside given kind of the fact that it trades at a slight discount to the industry. Lam Research, we really like Lam Research after it kind of bottomed here around this $80 level here and started to break out. Notice the breakout here, retested its support multiple times, and now it started to break out higher here, and we're looking for a continuation higher here for Lam Research. As it broke out here, it's outperforming the S&P 500, and then you look at kind of the valuations, it's still trading at a slight discount to its median valuation for the industry. But if you look at growth expectations, you're talking about growth that's basically in line with the industry, but margins that exceed its industry. So for those reasons, I think Lam Research should be trading at a valuation that's at a slight premium to its industry, and that would equate to a upside target of just a little over $100 or so. 105 to the upside is our upside target for Lam Research. CME, this is the stock that has recently really taken off here after we added it. So this is the stock that's also outperforming the S&P 500, as you can see, as it kind of climbed to new all-time highs or new 52-week highs. It's outperforming the S&P 500 as it did that. So those are kind of the things that we're typically looking for. It technically has already reached our upside target of 250, so we'll continue to monitor this. If you look at um, the valuations, it is starting to trade at a premium relative to the industry. But I think the one thing that's driving that valuation is its net margins. 57% net margins versus 20% for the industry average. So far more profitable, and typically companies that are far more profitable are the ones that command the highest premium valuations here. So 23 times forward earnings, in my opinion, is still by no means a stretch, and is supported by the really strong margins that we've seen here out of CME. Visa is another one that's gained nicely since we've added it. As you can see, the stock is now trading about 30 times forward earnings and has reached our 350 upside target here as well. So this is one that we are looking to potentially remove as it has reached our upside target here. As you can see, the growth expectations either beat or exceed, either meet or exceed its industry median. But really what's driving value for Visa is the 54% net margins. Very, very profitable stock, compared to its industry median, just like CME. And that's unlocking a lot of shareholder value here right now for Visa. Boeing continues to grind higher here. It's been a slow grind, but this is certainly one where the turnaround is continuing to take shape. I've been talking about Boeing here for the last couple of months now after this kind of bottoming formation, right? So as you can imagine, for multiple years, the stock has been declining, but it finally started to show some signs of a bottoming formation and recently broke out. We basically caught some of this breakout and this pullback here, and we're looking for that continuation higher for Boeing. It trades at 1.4 times sales, which is a pretty significant discount to the industry. I'm using price to sales because Boeing is not profitable at the moment. We're starting to turn that around. We're hoping to see a profit in 2025. And we have a CEO that's far more hands-on than the previous one. He's moved himself out to Seattle. He's refocus the entire company on its culture and safety. he's managed to get the Boeing through a labor dispute. He's got new funding for the company, and they're really just focused on putting their heads down and increasing deliveries and getting, some of the new planes like 777X through the regulatory hurdles so that it can become commercially viable. Because Airbus is to some degree eating its lunch in some of its primary markets in the Airbus A321, competing with the 737 MAX, and even potentially the 777 competition from the Airbus A350 family. So Boeing has a long road ahead of itself, but I think from an injury perspective, I think the U.S., especially in the environment that we find ourselves in, will likely be somewhat supportive to companies like Boeing, and that's the opportunity that I see here to the upside. And I think I'm going to play in this turnaround story here for Boeing. Dexcom, similar to a lot of the chart setups that I've shown you here so far, Dexcom kind of trading in this kind of bottoming range between 70 and 80, recently breaking out here to the upside. We're looking for that continuation here to fill that breakout here to fill the gap from this 105 level here to the upside. I'm sorry, $95 level here to the upside for Dexcom. This has been a slow grind higher, but as you can see, the stock's up 14% since we've added it back in December, early December. And this is one stock that does trade at a premium valuation, but it is somewhat supported by the growth expectations that we continue to see out of Dexcom that is orders of magnitude higher than the industry, with net margins that basically are in line with the industry. So this is one that we are monitoring pretty closely because this is the stock that has been a leader in this particular space, in the space of the continuous glucose monitoring space, is definitely the provider that's favored by insurance companies, and has taken a bit of a hit here in the last year, but finding its way back to recovery, and that's the upside play that we're using here in Dexcom. Meta, another nice gain here. We added this back in the beginning of Q4 of last year. It's gained about 20% since we've added it. Big opportunity, in my opinion. If you look at kind of valuations, it trades in line with its industry. Yet, if you look at growth expectations, it is in line or exceeds its industry. But most importantly, look at net margins north of 37% here versus the industry average of about 5. So that's really what supports what could support a much more premium valuation than what's trading at right now. And when we added Meta, it's trading at around 24 times forward earnings. So it's actually expanded a little bit since we've added it. But even though with that margin expansion, or multiple expansion, I'm looking for even further multiple expansion here. And I specifically think that the pullback that we've gotten here in the last week or so presents a nice opportunity to add some more exposure here to Meta if you don't already have it. A primary leader with regards to AR. And part of the reason why I take a bearish view on Apple is because of the work that Meta has been doing in augmented reality. Not only in software, but probably more importantly in hardware. Meta and even potentially Snapchat to some degree, seemingly a little bit actually ahead of what Apple has been working on. And Apple arguably has been working on this for much longer and has spent a lot more money on augmented reality than Meta has. Yet, it very much feels like Meta has a leg up from the next commercially viable product within this particular space that Apple claims is going to be the future of computing and the future of kind of their devices. And Apple at the moment has really yet to prove itself from that perspective. Even though they spent the last 10 years and $100 billion working on it, the Vision Pro has not sold well. Developers are no longer developing apps for it. And that, when developers stop developing for your product, it literally makes these types of products dead in the water and That's my biggest concern here for Apple going forward, and we'll talk about that here in a minute when we discuss Apple. But in the meantime, Meta is effectively eating Apple's lunch from that future outlook perspective, and then more importantly, from an AI perspective. If you look at Meta and just all of the leading LLM models that are built on open source, Meta's Llama is effectively at the core of most of the recent developments with regards to large language models. So if you look at Grok, you look at quite a few of the leading models, even DeepSeek R1, there's a lot of fingerprints of the Llama model behind it. So Meta clearly at the forefront within AI, and also one of the few companies at the moment that's actually monetizing AI. A lot of companies at the moment are spending tens of billions of dollars or even hundreds of billions of dollars building out AI infrastructure without necessarily a clear path as to how they're going to make that money back. And I'm not necessarily saying that Meta has that yet, but they are certainly one of the companies that have already started to monetize their user base with regards to AI, and is certainly a leader in this particular space. And that's why Meta, I think, in the last call it 4 months or so, has really taken off here from both an AI and AR perspective. Baidu, this is one we're taking on effectively as like a similar play here in the US for AI, but for China, looking at kind of unleashing Baidu as a tech company in the US from a regulatory perspective, because Baidu is one of the leading AI providers in China, looking for that potential to the upside. Now, if you look at the chart here, this chart is very much still down to the right, and we're looking for that breakout here to the upside. We haven't quite gotten that breakout here. If we zoom in, you have the formations of a bottoming formation, very early stages. As you can see, we added it when it's trading at 97. It's down about 6% since we've added it. But look at the valuation. It's trading at 9 times forward earnings versus 21 for the industry. Growth metrics that are kind of below industry average, but I think the thing that we should be looking at here is net margins. 17% net margins versus 8% for the industry. So, that tells me that should be at least supportive of a valuation that's closer to the industry average. And, it doesn't even have to get anywhere near the industry average for this to have substantial upside potential, which is why Baidu, at the moment, belongs in our bullish list as a more speculative play on kind of the unleashing of the AI tech stocks. Amgen, this is a stock that we've also added recently back here in beginning of February. As you can see, it's been trading kind of, it's bottomed out here and started to outperform the S&P 500 while it broke out. Earnings recently pushed it nicely towards our 280 resistance level, which would be our upside target here. We've actually exceeded our 280 target, and we're looking for that breakout here towards, the low 300s here. 315 is our upside target for Amgen. Still trading at it's trading at a slight premium relative to the industry. But if you look at growth expectations and net margins, it's essentially in line or slightly actually below. So we're going to keep a close eye here on Amgen as it gets closer to our 315 upside target. And we're very close to it at the moment. NVIDIA, this is one that's not a big round trip here since we've added it. But given that NVIDIA reports earnings on Wednesday this week, we'll see how that plays out. I still believe that NVIDIA represents one of the most undervalued stocks here at the moment, even though it's trading at 30 times forward earnings, which sounds expensive. But if you look at kind of growth expectations, there are virtually no other companies in the S&P 500 that's expecting to grow EPS north of 65% and revenues north of 55%, with net margins that are north of 55%. You kind of have individual stocks that have expecting high EPS growth or high revenue growth or high net margins. but nothing that has all three to the same degree, and nothing trading at about 30 times forward earnings. Which is why I still believe that NVIDIA represents one of the um, best opportunities within AI and the semiconductor space right now from a valuation perspective. And I'm going to dive into that a lot deeper here during our Thursday AI session on Thursday afternoon. So I hope that many of you will be able to join me for that session, because we'll do a deep dive into kind of how DeepSeek has affected the industry or the landscape, and how that is a potentially beneficiary for NVIDIA. Shopify continues to kind of grind higher here and break out here. We added Shopify after it kind of bottomed out here and started to break out and started to continue to outperform, and it's continued to run since we've added it back in September. It's up 63% since we've added the stock. This is one of those stocks that continues to trade at a premium to its industry, but if you look at growth expectations and net margins, it supports that higher valuation, and Shopify continues to take market share away from Amazon, small business from Amazon from a small business perspective, and that's why Shopify remains in our bullish list. Quanta Services, this is in the construction and water space, or rather electricity generation space. And with regards to our investments in AI, this is one that we continue to like, even though in the short run it's taking a bit of a squeeze here. If you look at kind of the investments coming down the line with regards to AI and the build out of data centers, Quanta Power is going to be an important component of that build out. It trades at a slight premium to its peers, but with growth expectations that exceed its industry, net margins that are slightly below. The valuation is certainly one that is concerning at the moment, but from a outlook perspective, I think this is one of the few stocks in this particular industry that will be a net beneficiary of the substantial amount of build out for AI infrastructure that we expect in the coming couple of years. The next one, this was one that we just added with today's report, which is Delta. The airlines have had a really nice run here since the sort of the summer here. So from August, this was a $38 stock. It's nearly doubled to $70 here in the span of 6 months here, and it's starting to show a little bit of weakness here. And then if you look at kind of growth expectations, right? Delta's basically trading in line with the industry, 8 times forward earnings versus 9 for the industry. But if you look at growth expectations, Delta is actually below the industry average for both top and bottom line. Net margins here of 5%, a little over 5%. We've recently seen those net margins get squeezed quite a bit here in the last couple of quarters. So, airline stocks that have done really well here in the last 6 months, starting to show a little bit of weakness here. And I'm concerned that there could be some further downside here in stocks like Delta that underneath the hood is actually not growing as fast as the rest of the industry, versus something like United Airlines, which is growing faster than the industry and actually trading at a lower valuation. Amazon, this was a bearish trade that we added here last week. Amazon, starting to show some weakness here from the stock, as you can see, as it kind of started to test these 225 support level here. It recently has been underperforming the S&P 500 as it tests these support levels. That's a sign that there's a potential further downside here for stocks like this. And just look at the valuations, trading at 35 times forward earnings. And from my perspective, that's not particularly supported by, this growth rate. This growth rate is higher than the industry average, but when net margins are continuing to get squeezed and it's below industry average, I think it's harder and harder to justify a valuation that's that much of a premium over the industry. 35 times forward earnings versus 22. So just from a valuation perspective, I think there's some downside risk to Amazon, especially as AWS revenues start to slow down. Kinder Morgan, we've seen oil prices continue to decline. We expect that oil services like Kinder Morgan will also start to decline here as well, especially since it trades at a premium valuation relative to its industry with growth metrics that aren't particularly stronger than the industry average. And lastly, Apple. We've had a bit of a start here. We added it back in December. This is a trade that was positive. It's turned back to kind of flat here right now, and I simply think that now is another opportunity to take a bearish position. And this is the trade that I sent out here as the trade of the week. Just the 33 times forward earnings is somewhat ridiculous in my opinion in terms of valuation when the industry's around 17, 18, especially if you look at growth expectations, they're actually below the industry average. And the only thing supporting a premium valuation is its net margins, 24% versus 8. And I just think that 33 times forward earnings is just sort of ridiculous given the growth expectations, especially if you look at Nvidia. Nvidia is trading at 30 times forward earnings. Meta is trading at 27 times forward earnings. Visa is trading at 30 times forward earnings. All of these stocks have growth expectations that are so much higher than Apple, so much net margins that are so much higher, yet it trades at a valuation that's cheaper than Apple. I think Apple represents right now some of the most expensive tech valuations right now, which is why I'm taking a bearish view on Apple and taking a more bullish view on stocks like Nvidia and Meta within tech. So that rounds out, the trade ideas here for the week. The markets just opened up here 2 minutes ago. I'll just quickly review this week. The big earnings is going to be Home Depot. You've got Nvidia on Wednesday, Salesforce on Wednesday, and Dell on Thursday, which will also give us a better read into kind of what the build out of AI will look like. But earnings season is definitely winding down. We do have a few big reports here this week that are worth paying attention to here, and the big one is going to be Friday, where we get the CPI print or PCE inflation print, which is the Fed's preferred inflation gauge. That's another market moving event this Friday. So keep an eye out on that for Friday morning. Otherwise, NVIDIA is going to be a big one here for the week, but I will update you on our Thursday session here for DeepSeek R1, where we kind of do a deep dive into the current landscape of AI and how the latest DeepSeek model will affect the views of of the overall industry. So please scan that QR code on your screen. That's going to allow you to register for that session here this Thursday on a deep dive into DeepSeek. With that, that covers what I wanted to share with you here today. I hope that this gives you a better understanding of kind of the number one, the macro picture, but more importantly, a deep dive into each of the bullish and bearish ideas that we have on our research list, because those are the ideas that we will be pulling from throughout the week to send you trading signals on. So it's really important that you've done your homework on Monday morning. You understand the technical and fundamental views of each of these stocks, so that if we send you a trading signal tomorrow on one of these stocks, you're ready to pull the trigger here. You're not scrambling to do your fundamental research or do your research on an underlying stock to decide whether it's a trading signal that you agree with and that you're going to place a trade on. So hopefully this kind of gives you that amazing start to your week so that you can have a more productive and more efficient week for trading. With that, thank you so much. I hope you guys have a great trading day, and I'll see you guys here on Thursday afternoon session.